Hi, welcome to a series of videos where we apply inventory accounting in a relatively simple setting, but it's exactly like it happens in the real world. There's just a lot more transactions. Now we're going to do this case 6 times. We're going to do it using Perpetual inventory system, and then we're going to use it using the periodic inventory system. And within each of those, within the perpetual system and within the periodic system, we're going to use the 3 most common cost flow assumptions. We're going to apply FIFO, then we're going to apply LIFO, and then we're going to apply average cost within the perpetual system. Then we will apply FIFO and then LIFO and then average cost within a periodic system. In this video, we start with perpetual FIFO. And here it is. Spirits Wholesale Outlet sells only vintage American Basketball Association basketballs. These balls are a popular item in sports retail stores. Spirits began 2024 with 400 basketballs in inventory. These balls were purchased near the end of 2023 for $25 each. Okay, so far we have 400 in inventory. On January 8th, they purchased an additional 200 balls at $28 each. And so we now have a total of 600 balls, 400 of which were in beginning inventory and were purchased at $25 each, and then 200 were purchased in early January for $28 each. On January 10th, we sold 250 of our 600 in inventory. On January 19th, we bought 400 more, this time for $30 each. So we have escalating inventory prices. And then on January 25th, we sold 200 more. There were 550 units on hand at the end of the month. All right. So you'll get used to these facts because we're going to use them with the 2 inventory systems and then the 3 cost flow assumptions within each inventory system. All right. And basically what we're going to want to do is show what ending inventory and cost of goods sold would be under each of the respective systems, and then cost flow in conjunction with the chosen cost flow assumption. And also what the journal entries, we'll do the journal entries and then the ending balance in inventory and cost of goods sold. Okay, so now we're starting with perpetual FIFO. And to that end, please take a moment and give it a work the case on your own. I think you'll get it right. All right, welcome back. Hopefully you paused this video and found that quite easy. Here is the summary of what I just read. Bring this down a little bit, make it bigger. There we go. The beginning inventory was 400 at 25. Then we purchased 200 at 28, sold 250, purchased 400 at 30, and then sold 200. So available for sale was 1,000, sold was 450, and ending inventory is 550. All right. So let's look at the perpetual inventory system with the FIFO cost flow assumption. That's our entry on January 8th. It won't matter what cost flow assumption we're using, because that only matters when we sell items. We have to use an assumption of which items were sold. So we debit inventory for $5,600 and credit cash for $5,600, and that is for that purchase. Remember, this was an ending inventory, so that's already in your ledger account. So at this point, your ledger account started looking like that, and now looks like that, where we have the 400 at 25 is 10,000, and then we just added $5,600 more of cost. And then if you want to think about it in units, we have 600. All right. And that's after that purchase. On January 10th, we have a sale. Bring this back over. Sorry. All right. So we sell 250. And under FIFO assumption, we assume that all came from the first that were in inventory, the earliest purchased. So they all came from these 400, we assume. Thus, the sale was at $50 a ball. So our sales revenue is $12,500, 250 times 50. And so we have an accounts receivable for that amount. And, or of course, cash if the customer paid cash. And then the cost of goods sold, this is where FIFO and LIFO, and indeed the inventory system itself, matter. Here we assume FIFO. So we assume that the balls sold were from that, all from this one, because there was 400 at 25 and we only sold 250. And so therefore, the cost of goods sold and the out of inventory is 250 balls that were purchased at $25 per ball. And so far in our perpetual ledger, that's what we have. We have 350 units left, balls, and the dollar balance is 15,600 minus 6,250. All right. Sorry, hold off on that for just a moment. Remember our next transaction. That's what we did on January 10th. On January 19th, we have another purchase. This one was 400. $30. I'm sorry. $30 per ball. So now within our ledger system, our general ledger accounts look like this. Cost of goods sold didn't change as a result of that transaction, but we do have another debit when we posted that journal entry we just saw to the inventory account. So now the number of balls is up to 700 again, 750, because we had 350 before the purchase. And the total inventory cost is 10,000 plus 5,600 minus 60,250 plus 12,000. All right, and on January 25th, we sold 200 more basketballs for $50. And the cost of the goods sold, well, now we have to do a little thinking here, or we can go to this ledger account. But let's go back up to our table of the purchases. We just sold, remember this was down after that $250 sale, or that sale of 250 balls. This was down to 150. So when we sold 200 this time, we assume we sold these 150 and 50 of those 200 at 28. So there was cost of goods sold, 150 at 25 plus 50 at 28. And if you do the math on that, it's 5,150. And that's the end of the month. So now I posted all to the ledger, and then I went ahead and balanced the ledger. And our cost of goods sold was 400 balls, 450, at a total no, 400 sold, no, 450, I'm sorry, 250, 450 sold, and 550 left, and those 550 left have a cost of 16,200. And though on the financial statements, sales revenue is 22,500. That's going to be true regardless of our cost flow assumption. What's going to be different is the cost of goods sold is 11,400, meaning gross profit is 11,100, and the ending inventory is 16,200. And the cost of goods available for sale the whole month was 27,600. All right, and that is applying perpetual FIFO. In the next video, we'll use a perpetual inventory system again and apply the last in, first out LIFO cost flow assumption. See you there. If you want to get a head start, please go ahead and work it, and then just join the video when you're done. Thank you for your attention and hard work.